Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. Trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Welcome back to the show, Danielle.
Hey, thanks, Jim.
Danielle, the U.S. Fed has made an emergency 50 basis point cut to their administered interest rate. Is this a good idea?
Well, it's the only idea they have, right? So if everything is, what's that saying? If all you've got's a hammer, everything looks like a nail. That's basically, the expectation that's developed in the last decade in particular is that central banks can respond to any ailment and make it all better. And of course, that isn't the case. And what they have left to work with here is 1.5% of room on their rate to begin with. And so they cut that by a half point today. Now, an emergency inter-meeting announcement like that is a rarity. The last time they did that was in September of 2008. So it is a precursor typically to much worse conditions coming. So my partner Corey's done this great chart of the S&P 500 and all the rate cuts that followed in the last two bear markets, and it cut all the way down as the S&P plunged, and it wasn't able to avert 50% declines plus in each of those last two cycles, and that's when they started from, as we've mentioned before, 6% in 2006, where they cut to 1 by '03, and they had 5.25 room at the peak in the 2006 cycle, and they cut that down to 0.25 by 2009. So they had a lot more room to work with in terms of offering stimulus, and the world was much less indebted back then. So they had, theoretically more room to borrow and consume. Of course, we're hitting this cycle after a decade of the loosest economic financial conditions in the history of the world, pretty much, and so everyone has piled on significantly more debt. And bad risk management and bad cash management behaviors have really blossomed in this time. It's also part and parcel with the fact that low rates were left so long. When they cut to 0.25, they left them there for many years and only began to raise them very slowly into 2018. And then, of course, all the while we're pounding in this quantitative easing. Even when they started to taper that, they were doing emergency injections almost on a daily basis in the last 6 months as the overnight markets began to seize up again. So the horror of horror is that, we've got this shock in the form of a virus sweeping the world, which no one actually knows how far and fast that will go, and we're all hopeful that we'll get it contained, as they say, but it's likely that it's going to continue spreading for many months. So that was a shock that, was a foreseeable shock, but not one that you could ever say, when the next one's going to hit kind of thing. But the preparation this time is almost nil in terms of the, cash buffers, the cash flow management, the investing in efficiency, all the things that would make these shocks more easy to bear have not panned out this cycle. But one of the things that has happened with all that free money was that many sectors overbuilt themselves and overlevered themselves. So, for example, airlines, and we've spoke of this in the past, Jim, with the easy credit flowing, junk bonds easy to raise, and lots of consumers being able to put things on credit cards in the past decade, the amount of airline traffic in the world actually doubled. And so what happened in that sector is that airlines borrowed a ton of money at cheap rates and really built out their fleet to the largest they've ever had. A whole bunch of money was pumped into, airports and the infrastructure that supports them. And what happened was a lot of money was borrowed to accomplish this. then as rates began to rise and as stress began to build in the credit market in the last little while, that funding has become more expensive and difficult to get. And there's been a huge threat, and we've mentioned this in the past, I've been writing about it for some time, that as this credit crunch hit, that many of these bonds would come up for reinvestment where they need new people to loan them the money, or the existing owners to loan them the money so that they can roll them back over. And that was going to get harder and harder. And that's exactly what's happening. And then what happens is when there's a hit to revenue, as there is right now in the world in many sectors because of the shock of this virus, what happens is that the credit downgrading begins. So you now have record amounts of debt, and your cash flow is taking a hit because of the downturn in the global economy. Suddenly you're getting downgraded from barely investment grade to junk, and a bunch of institutional investors and funds are not able to hold your bonds at all when they're downgraded to junk. They don't meet their investment requirements, and so suddenly you are having a harder and harder time finding ways to roll over your debt. That's the very definition of what's driving a default cycle. So that's separate and apart from the stock market. That's the corporations trying to refinance their bloated debt loads. And then that's not the only sector, of course. We've seen a very similar thing in the oil and gas sector, right, where the boom, particularly into 2008, the rebound into 2011, drove this huge investment cycle into commodities in general and into energy, fossil fuels in particular, and of course a massive build out where you had all these new players and types of equipment and systems come online, and you really flood the marketplace with supply just as debt is very high. And all these factors started to happen. So again, it was harder and harder for many of these energy companies to roll over debt. And that's becoming even more the case now as investor appetite starts to pull in. So there's so many moving parts in this, but the themes are quite simple. We've got, even as the U.S. Fed slashed interest rates today, we have the bond market bidding long-term treasuries. So what that's saying is the long-term bond market is saying that the cut to the short end by the central banks is not going to be stimulative, is not going to reverse this downtrend that began in the world actually in 2018, and global trade that contracted in 2019, and all of the stuff that's happening in the first half of 20 is just magnifying all those negative impacts in terms of dropped revenue and cash flow crunch and all these problems. So although the central bank is this figurehead who people, like President Trump was demanding, even after they cut a half point today, demanding that they do more. I mean, it's just a ludicrous assumption or a ludicrous expectation that these policymakers can, counter all these negative forces with this 1.5% of rate room and a few more bond buying exercises. Like, it's just, we've really made a Frankenstein of enormous proportions this cycle with all of these reckless behaviors. And, it's playing out now. So I expect that, we are likely to see a full-on bear market here. It's been stalled a few times, since 2015 when the first sort of, business cycle kind of topped out and risky assets started to sell off, and then you got all these waves of central bank intervention. But I really think we're at the end of any meaningful room there on all these different policies, and you're having a mean reversion cycle, which is extremely healthy and necessary. It was what Jim Grant calls the value restoration project, which is so badly needed in the world. It needs to clean out the speculators and highly levered junk companies and zombies, so to speak, and really reward those people who are prudent managers, who have, bought things that aren't highly speculative, who are not going to be forced to sell assets as prices drop, which is what the masses do in this type of an environment. And the people who can maintain liquidity and manage their cash flow properly will get great opportunities down the road here, but it's likely to continue for the next many months before the bottoming process completes.
We'll have more with Danielle Park right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Danielle Park. Danielle, a big dump in interest rates. Will that fuel the housing market?
Well, yeah, you might see, again, a few more souls wanting to go a little deeper still into debt to try and reach for unaffordable housing, particularly in places like Canada. Certainly our 5-year Treasury bond today is below 1%, 0.92 currently, which is roughly where our mortgage rates are tied to that. So as people with floating rate mortgages won't get any benefit typically until the central bank cuts interest rates, which affects prime, and most floating rate credits in Canada are based on prime. So at the very short end, people aren't likely to see a change in the near term, but in terms of the longer term, fixed term rates, they'll likely see a decline. The 10-year Canada bond today is just under 1%, Jim. We're really in a remarkable historical environment where financial conditions that have just been, I think of it as, when something's been just flogged and abused so long, like if you've never maintained your car or treated it well, you just drive it into the dirt and suddenly everything kind of falls apart and it lets you down. This is really how we've treated the financial situation of households and companies in the past 10 years in particular. And so we shouldn't be shocked that the engine's kind of falling out here. We really have to go through a healing process. Now, again, part of it, once you've got rates as low as they are, people that are highly indebted get, cutting them a little more, or having it go down a tiny bit more, at the best it will just extend their sort of insolvency event by, a little bit of time perhaps. But as we've already seen over the last year, the spike in bankruptcy filings and insolvency filings in Canada have been rising at double-digit rates month after month after month. So many of these people are already too far gone, so a slightly lower rate's not going to help. Yes, a few more people may push themselves into the housing market, but you're really at the end of that magic elixir in terms of lower rates, and this is where you need to get either a big increase in revenue and income, whether it's for businesses and for households in terms of wages, or you're going to have to get lower prices, right? Something has to give for this equation to balance once more. And the issue here is that the world is moving into this sustained down period, which has been magnified by the corona shock. And that means that revenues are not likely to bounce back in the near term, and there's no wage pressure in this environment because not only do we have a demand shock where people are able to consume less or interested to go out less and consume because of their fears of the current environment, but you also have this supply shock where if you look at Canada, our export numbers are weak. Our business investment is weak. So these are the other engines that the Bank of Canada might hope would pick up the slack here. If we have a lower Canadian dollar, which we do, the Bank of Canada may say, great, that should help our exports. But in fact, that's not happening in this type of an environment because exports are falling all over the world. And I thought it was interesting today because the Bank of Canada didn't cut interest rates yet yesterday, stayed pat, at 1.75, trying to keep some dry powder for as this downturn really intensifies, I think. They were trying to not do a knee-jerk reaction and give up whatever persuasion effect they may have when they need it later. But interestingly, even though they didn't cut and the Fed surprised with a 0.5 point today, the Canadian dollar weakening right now against the U.S. dollar. So typically if you saw a big surprise cut out of the U.S. and Canada at higher rates, you might see a rally in the Canadian dollar against the U.S. dollar. But the fact that you don't and that you see the loonie weaker today in this environment just really confirms my thesis that this is because of the fact that it's a global downturn and that Canada is linked to our largest trading partner and that our exports are weak and not likely to improve for some time. So it's a big macro story here, but it's also a micro story in the sense of how ill-prepared every level of the economy is for this kind of shock this time. The least prepared or with the least amount of margin of safety or flexibility to sort of ride these things out that we've had in any cycle since I've been, in the markets. Certainly, I would say probably this is more akin to what we saw in the 1980s sort of style, but even then the debt levels were not the same as they are today. So I think it's a perfect storm of many things.
We'll have more with Danielle Park right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, has Canada received a double whammy here, not only the threat from the coronavirus, but also all of these blockades supposedly in tandem or in support of the Wet'suwet'en people in northern BC, but the hereditary chiefs there have reached a tentative agreement with the federal and provincial governments, yet these blockades are continuing. And people have pointed out there are shortages of toilet paper in some places. Is that because there's been a run on it because of a fear of the virus, or the toilet paper supplies just haven't been able to get out there because of the blockades?
Well, I think it's probably both, right? I think it's, like I said, I think it's the blockades. Like first of all, you had the conductor strike in November of 2019. That was kind of the first disruption to rail traffic in Canada. Then you had the blockades that have happened in the past couple of months. And all of those things were interruptions of goods and caused cash flow disruption for, farmers and producers of goods that were needing to sell and move those properties across the country. So obviously a very serious impact. Again, very difficult for thinly capitalized, highly indebted companies and individuals to sustain any kind of interruption. So there's no question that an interruption in transmission of those goods late in this particular cycle would have negative knock-on effects for many participants that are affected. And certainly it would, I guess my point is that it wouldn't be a cause insufficient of itself to cause this downturn or these shortages, but it's certainly a magnifier of the impact. And again, late in the cycle, right? If something like this happened coming out of a downturn, like in 2002-03, when you'd had a big washout period, where asset values had fallen by more than half, where, a lot of people the weak players had been sort of wiped out or had already declared bankruptcy, where you had this clearing event and you had expectations very low, sentiment very low. When you have a disruption in that kind of an event, it's much more, people are already sort of thinking the worst, so it typically is a surprise to the upside in terms of not as bad as they'd feared. But when you have coming into it with a period of extreme overconfidence and over-leverage and everything that we had in the last few years, it always hits much harder, and I think that's exactly what's happening.
A lot of young traders have never experienced a downturn. 12 years of rising markets. Does that hamper the ability to adjust to a downturn like this? You may have a lot of inexperienced staff.
Absolutely the case. I mean, I first came into the money management business in the late 1990s, 1997, and, you know, I'm very aware of you can have all the book learning and understanding in the world, but until you get into the seat doing the job and see the way human behaviors interact, you really don't appreciate the significance and severity and the lasting impacts that can come from these type of cycles. And I think that, you know, that's very typical of this, of the financial business in general. You tend to have a lot of fresh-faced, you know, people coming out that, especially when you haven't had a significant bear market in a decade, which is very anomalous, as we've discussed many times. That's longer than usual. So there is a lot of people in the so-called business today that have not appreciated or lived through the nitty-gritty of what these downturns are like. Also, the fact that we had a sharp V recovery in 2009, which was an anomalous bounce back in a very record amount of time between 2009 and 11, it was a quick recovery. That also sets people up with a sort of an unreasonable expectation that, you know, buy the dip at all times and that everything recovers quickly. But in fact, if you've been through a few cycles beyond that one, you appreciate that very often these things end up in very, you know, grinding down over a year and two before they make a bottom. And then prices may not recover for a decade or more from there in terms of the prior cycle peak. So all these things are the stuff that's not necessarily discussed in the, you know, manuals on how to sell people financial products or equity risk, which is the main focus of the entire business, is how do we get people into the highest fee products, which is on the equity and corporate debt side. So all of the focus is how do we get chief strategists of all these various franchises to get out there and tell people that, you know, don't worry about this, quote, volatility. But volatility can be, you know, literally decapitating in this type of a sustained downturn, and that's what people often learn the very hard way. So I caution them. You know, I always say, and I was writing about how I heard a particular investment strategist saying that, you know, when markets were selling off, oh, well, you can't rationalize an irrational market. You can't, you know, and I was saying, well, it's been so irrational for the past few years to the upside, right, in terms of the extraordinary gains which were made while earnings were contracting, while global growth was turning down, while all the fundamentals were deteriorating. And yet everyone was rationalizing why things were going up every single day. And, you know, so there's just that inherent bias and dichotomy in the industry. So it's very important that people realize that, you know, if they've been riding the thing up, that's great, but they were not in a rational environment then, and it's not too late to assess one's risk exposure now, because there's a lot of levered participants in there. It's not all buy and hold people. It's not all, you know, people have this impression that the market is dominated by these sober minds or sober money or, you know, savvy investors. And in particular cycle, as for sure, it's been dominated by levered trading, algorithms, you know, momentum, nothing to do with risk assessment or you know, fundamental analysis. And so they got so far away from anything that made sense on an investment thesis. And so people have been basically doing levered speculation. And that always ends in a very catastrophic event, typically, you know, with losses in the 50% to 80% range. I'm not making this up. This is a typical conclusion to a market cycle like the one we've been through. And so I just, you know, I caution people that it's not too late to get a second opinion, to review your holdings, to have someone look under the hood of your funds and ETFs and different portfolios to see how much diversification you actually have in terms of meaningful asset, you know, and a negative correlation between asset classes, because I think most people are holding things that are moving together. While they were going up, they thought that was genius. While they're going down, it could be potentially life changing in a negative way. So it's really important to act before you get to that point where you're low in the cycle the losses have already happened, and now you're panicking and liquidating at the bottom.
Did someone once say the genius of wealth isn't making money, it's holding on to it in bad times?
Well, actually, someone wrote to me the other day saying that they wanted to get their money working for them. That it was important to get their money working for them. And there's so many ways that our money can work for us. By, for example, maintaining a shelter over our heads that keeps our family healthy and happy. If we can do that without taking on too much debt and having too much stress that the home is a mess. Investing in our education so that we can, be well equipped, investing in our own employment if we want to have a business or start something on the side, investing in our children so they can start. All these things require having cash built up and allocated to different, goals. But this idea that you then just blindly throw money into things that are sold to you without you doing any actual, serious analysis about prospects of return and risk, is a very misguided idea, and it's something that people have to be very careful about. So yes, there's all sorts of things. The brilliance of effective financial management is building up savings, living within your means, having different pots allocated for different goals that serve our life vision, and then protecting the principal when it's for things like retirement to make sure that we are compounding returns over time. But the biggest threat to compounding pools of money over time is capital losses. And that's why it has long been said that the number one rule is to not lose money, and the number two rule is to not forget the first rule. In this environment, we've had a whole bunch of what I call mindless flows, which is people just trend following, momentum buying, taking credit for things going up when in fact it was a whole bunch of financial gimmicks that were driving prices higher. And then when the mean reversion begins, when the reality starts to bring prices back down and leveraged selling starts to crescendo and everybody's trying to get out, those same people who were blindly riding that up and taking credit for it, don't want any responsibility for the losses that follow. This is true of President Trump. This is going to be true of most asset managers and advisors out there, and it's true of the individuals who have signed up for fantastical expectations and not done any real work around looking at what the risk their money is at. So it takes a bunch of players to make a mess of it, but actually, prudent financial management is not complicated, but it is disciplined. And it's the discipline part that people have the hardest time continuing with, I think.
Danielle, thank you so much for being on the show.
Hey, my pleasure. Good luck.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.